In this video, I want to break down exactly what you need to know about the world of finance if you're interested in the world of law. No one teaches you this stuff. Let me give you one video to break down exactly what you need to know. I like to imagine this as a skill tree, and you kind of level up on the skill tree as you complete more modules. So I'd break down what you need to know about finance into 3 sections. One is thinking about why companies raise money in the first place. Second is the financial market. So who are the players? How does the economy work? And then the third is the financial statements. So when I run a business, what are the financial statements that I have to look at? Now, in this video, I want to focus especially on that part on the left, which is equity and debt. So equity can be broken down into private and public equity, and debt can be broken down into loans and bonds. Now let's do a quick fire on why companies raise money in the first place. We'll go into detail about equity and debt, but it helps to understand just like what's the point of any of this. Really what I have in mind always when I'm thinking about the world of business, I've come to learn this more over time, is the whole point of like businesses existing in the financial world is to make more money. That's really what it comes down to. And they care about, I want to make more money than I did previously. And so think about raising finance in that context, which is my decision to raise money, whether equity or debt, comes down to, do I think it will make even more money than I would otherwise, say by spending the cash myself? And we can break the reasons for why we raise money into a few different subsections. One is like thinking about, I just don't have enough cash in my bank at the moment. Imagine like startups, for example. I want employees and I want a team and I want offices and technology. I probably don't have that cash already. And that's why startups will often raise equity in the first place. Second is thinking about working capital, which is just like day-to-day funds. So say my money from my business, my income comes at a certain time, but also my expenses come out. And at times there can be a mismatch between the two. And so working capital, like a overdraft facility, can help you to bridge the gap. And it's useful for like day-to-day expenses that come through. Next is a type of industry, which is just thinking about, say in some industries like energy, pharmaceuticals, there are really high costs to starting up. Say if I wanted to start up a pharmaceutical company and I wanted a huge research and development project on a new drug, that's costly and I need to fund that somehow. And I probably don't have the cash to just fund that myself. Next is growing market share. Really topical right now in the space of AI and technology. There's a race at the moment between OpenAI and Anthropic. Whoever's going to be first in that space and capture most consumers using their product daily is going to win, is usually how it's seen as. And so they need funds to do that. And it's kind of a race and like a winner takes all. And so whoever raises the most money to then invest back into the business, make the better product, gets more market share. The same applies in the law firm space, which is thinking about companies like Harvey AI. Really in the law firm space, there is probably going to be 1 or 2 dominant companies that gets all the contracts of the law firms, is really what lawyers use day to day in the space of AI. And so it really helps there to raise lots of money over a small period of time, get those contracts, and then keep making the product better. Next is thinking about distressed companies. Really what we're saying here is just raising finance is not just if you're doing well. It's also if you're in a tricky situation, you may need to raise money. Say, for example, a bridging loan to hold you for a period of time until you get some income coming in. And the last point I just mentioned here is the opportunity for existing investors to cash out. This is especially in the context of equity. We'll come into this in more detail. Really, the idea here is in many companies, there are investors. Those investors often have shares, so pieces of ownership in that company, and they make their money when they sell the shares they have to someone else. And often that can happen in the context of a public sale. And so they may also be a driving factor towards why a company decides to raise money. So the point here is just to give you a more complete picture of the reasons behind it. But when we go deep into equity and debt, this will become much more clear. Okay, so how do companies raise money in the first place? Let's go back to that skill tree. And I always just have that visual in my head, which is just understanding, okay, a company wants to raise money, 2 options, equity and debt. Obviously in practice, there's some caveats. For example, some debt can convert into equity. But for your purposes, let's just imagine the 2 simple parts, equity on one side, debt on the other side. Now, what is equity? Equity is just, if I'm a company, I'm going to sell a stake in my business, so a piece of ownership, in return for some money from an investor or a group of investors. And so the people or the companies that become the investors are called the shareholders in this case. Then on the other side, we have debt, and debt just means borrowing money. So I'm going to go to a bank, for example, or a lender or a large base of lenders, and I'm saying I want to borrow a bit of money, and usually I'll pay it back with some interest over time. And that interest is the cost of borrowing that money. Now, if we compare equity and debt, just imagine like companies have to make a decision as to what proportion of the money they want to raise through equity or debt. Do they want to do both? Do they want to do one or the other? And each of those has implications. And it's really helpful to understand what drives those factors, largely because a company is driven by the financial decisions it makes. That determines what it decides to invest in. And so this is a really important decision. Let's do a simple comparison of equity and debt. And we can break that down into a few categories. One is repayments. So do you have to pay the money back? In the context of equity, you don't have to pay the money back. That's the nice side of equity. Your shareholders are making a bet that you're going to do really well. But also, if you don't do so well, that's the risk of getting to benefit from the upside, right? Is there's no commitment to repay back that money. That's very different to debt. Debt is a contractual arrangement. It's an agreement in a contract which says, you give me this money, I'll pay it back with interest over time. And that's really important to know, because if you don't do well, it's important to remember in the context of debt, the obligation to pay that money back, and whatever's in the loan agreement determines that. Next, on the side of control, one of the biggest costs, as you probably heard, on the side of equity is I'm going to give up a piece of the business. So imagine in the context of TCLA, if I find investors and if investors invest in TCLA, what we're saying is they get a ownership to some of the profits of the business. Say if I distribute that as dividends, also if I sell it, some of the money will go to investors. And also, depending on their involvement, they may have some say in how the company is run. And on a bigger scale, if you imagine, that can be very influential. On the side of debt, it doesn't dilute ownership. They don't really have they don't have an ownership in the business. They may have rights to say certain stuff in terms of what you can or can't do, but we're not talking about actually a permanent stake in the business. And so that's one of the big downsides of equity. Now, on the side of what happens when things go wrong. So if things go wrong, you don't have to pay the investors back. They're also last on the rung to be repaid back. So imagine like a company goes bust. Usually all the lenders get paid back first and the shareholders are last. So that's something that has to be thought about from both sides. On the side of debt though, a debt could be what we call secured. We'll come into that in more detail later, but they may have the right to repossess some of the assets to make their money back. Now, how easy is it to find the stuff on availability? Like how easy is it to raise money on equity? Well, if I want to raise money through TCLA, for example, I have to go out and find investors. So I have to pitch them and say, we're going to be worth this amount. This is why you should invest. It's a very manual process as a private company. And so it's quite hard to raise equity. Same in the context of public equity. If I want to raise public equity, there's lots of rules around that, lots of restrictions, which we'll come onto. Debt, it's much easier. Imagine we want to raise money, just go to the bank, which our account is with, ask for a loan, they'll make a financial decision. If it's for small amounts, if it's for much bigger amounts, it's still seen as easier compared to equity. The main thing to understand here is when it comes to deciding between equity and debt, for this point about tax, debt is usually seen as more beneficial, reduces the cost of borrowing money. And what that means is imagine a company declares an amount of profit, say it's like £10 million in a financial year, and the profit is just the revenue minus the expenses. Now imagine that the company has interest to pay of £2 million. What that means is it reduces the amount of profit that company has, the amount of taxable profit, we say, to £8 million. And that's great for a company. So they're now paying tax on that 8 million because we can deduct the interest payment. And so this is what we call the tax deductibility of interest payments. What this is effectively doing is it's lowering the cost of borrowing money because of this ability to deduct the interest payments. And so the final part is just think about where do the costs come from. Equity, we've said the big main cost you're thinking about is I'm giving up permanent ownership in the company. Whereas on the side of debt, it's, okay, the interest charge, the security, and then what happens when things go wrong. So we've done a big picture overview of equity compared to debt. Now I want to deep dive into equity and then we'll deep dive into debt. And equity can be broken down into a private sale and a public sale. If we go back to that skill tree, Imagine raising money, it's broken down into equity and debt. And then equity, we're saying that's broken down into a private sale and a public sale. And so how do private companies raise equity? That's what we mean by private sale. Now, there is a journey that many companies go through when they raise equity as a private company. And it looks like this. It starts on, if you're lucky, this small scale, I'm going to raise some money from friends and family. Usually they'll take a very tiny stake, they'll invest a very small amount of money, and they have the potential for the highest return because they're investing very early in the early stage of the business, but also the highest risk if things don't go well. Obviously, also just keep in mind, not everyone has access to capital from friends and family. It's why I usually consider the first kind of official stage of equity finance for a private company to be angel investment. So that's next on the rung of the ladder. And angel investment, just imagine that that's wealthy people. So that could be formal angel investors, whether that's people you might see on things like Dragon's Den or Shark Tank in the US. Or it could also be like celebrities or athletes. This has really exploded over time as people make more money and they've decided to invest some of that money into companies. Now, they are also investing small amounts of their own money into a company for a small stake in the business. The next stage, and this is where we're starting to think about raising larger amounts of money, is what we call venture capital. And venture capital firms, they raise money from what we call a fund, which is investments from different types of parties go into this fund, they pool it together, and they still usually are taking small stakes in companies, what we call a minority stake, in return for giving you some money. But the important thing to keep in mind here is the basic bet of venture capital is, okay, most companies we invest in are going to go bust, but we hope a small number of you become billion-dollar companies or become, say, like the next Uber, the next OpenAI, Anthropic. That's really the model of venture capital. And therefore, it's suitable for companies that really have a plan for global domination. They really want to take over the world. They think they'll be absolutely massive. Otherwise, you're not really a good fit for venture capital. And venture capital, from the perspective of the firm, they are investing in still quite early stage companies. So usually what happens is there are a series of rounds as a company raises more and more venture capital, starting with the kind of very early investment to further rounds over time. On the side of law firms, there are law firms that focus specifically on venture capital. And so whether that's advising the founders of companies or the companies receiving investment to advising the investors. And there are firms like, say, Goodwin in the UK, Taylor Wessing, Osborne Clarke, that have very good venture capital practices. Then we move on to the side of private equity. And private equity, it's still in this context of private companies raising money, but we're talking about the most amount of money. It could be a minority stake, but it could also be a majority stake. So they take over 50% of the business. And private equity looks to buy more established companies compared to what we said in venture capital, which is earlier stage companies. Now, it's worth spending more time on private equity, largely because this has had a huge transformation in the law firm space. And there are firms like Kirkland and Latham that have become the largest law firms in the world, partly as a result of private equity, which is the explosion of investment in this space over the past few decades. And the law firms that have built really established relationships with private equity firms has really helped that sector. And so there are many like future lawyers that look to go into private equity. These are firms that are focused on that area, say like Kirkland, Weil, Sidley Austin, Ropes and Gray. These are all private equity focused firms, which is they exist to kind of service the needs of private equity firms. And similar, you kind of have practices built around that. So say antitrust or leverage finance, these also help to service the different parts of the needs of a private equity firm. Now, let me explain this, and it's worth spending a bit more time on this. I know it can be a bit trickier to understand, but it does become simpler over time. This idea is we start with investors and wealthy people. Now, the investors are usually called institutional investors. Or an institutional investor is a financial institution that has a lot of money, and it needs to put that money somewhere. And I'll give you a few examples. So imagine millions of people in the world, they buy insurance and say, for example, you bought travel insurance in the past. That money goes to an insurance company. And the whole model of insurance is we're going to pay out if there's some kind of emergency event where that's needed. But that means they're amassing lots of capital over time from the, say, monthly premiums that you pay, and they need to put that money somewhere. The same goes to pension funds, which is when you put your money into a pension, but it's only paid out a lot later. Or endowment funds. This is like, for example, large universities, great example is Harvard, where they get loads of donations and they have capital to then invest that somewhere. And then hedge funds, which are usually, I'd say, on the riskier side of investing in companies. And often what they'll do is they'll do a lot of market research into the kind of companies they invest in. They will hedge their investments. What that means is they will go long a company, believing it will go up in value, but also go short in a company, which is we're going to bet the value of the company goes down and then make the money on the difference. And then largely sovereign wealth funds, which is, say, a government, it has income coming in from people and it needs to invest that money somewhere. And you might be wondering, like, why do they invest that money? Well, imagine you have like loads of cash. You don't really want that sitting around. It will erode in value over time due to this thing called inflation. And so they need to put that money somewhere. And these institutional investors and wealthy people, they kind of run the financial markets, which is just the amount of capital they have to invest. And some of that money goes into private equity, which is to say the whole bet of private equity, their promise is if you put your money with us, we'll give you more of a return than you would otherwise. And we're going to take some slightly riskier strategies as they come. And so this money goes into what we call a fund. A fund is just a pool of investment from different investors. And this is the funds practice of a law firm that gets involved in this. Now, the private equity fund will then have a mandate to invest, for example, in certain types of companies or in a certain sector. And over a period of time, it will buy companies. And as it buys companies, this is like the corporate private equity practice of a law firm. It will then try to find companies that the ones that it buys that it feels are undervalued. So what it's basically saying is, we think if we make some changes, we can buy this company or invest in it, make some changes, turn it around for more money over time. And so say they find a business and they bring in a new CEO, or they load debt onto the business, which means they're borrowing a lot of money so it can then acquire other companies in the space, or it improves the technology, efficiency, gives the management some shares so they're really incentivized to perform well, or brings in outside management. This is this whole model of like improving companies. And then they'll sell those companies, whether that's through a public sale, so we'll come onto this, but an IPO, or sell it to another company or to another private equity firm. And so that difference is how it makes money, which it returns to its investors and then pays itself. And the financials there, the kind of way they get paid is a combination of management fees, which is fees for running the companies it buys, as well as what we call carried interest, which is a percentage of the profits of the company after it's sold them. And so this is this model of private equity. I recommend taking a bit more time with this, but hopefully you can understand that complete picture. And this is, as we said, the largest chunks of capital in the space of private equity. So we've done private equity. That's this umbrella term for the type of ways that a private company can raise money through equity. And we've said friends and family, angel investment, venture capital, and then this last stage of private equity can be a bit confusing because private equity is an umbrella term for private companies raising money, but it's also this thing in itself of private equity firms investing in companies. Now, we move over to public equity. And just to be clear what the differences are, imagine like the default in the UK is most companies are private. They, not anyone can buy shares in that company. You have to manually find shareholders to invest in your company, and there's rules around that. A public company is a little different. What we're saying here is everyday investors, people like you and me, can invest in those companies. And so we could easily go into an app and find those companies online and buy shares in them and sell those shares. And that's this domain of being a public company. Now, the first time a public company raises money, we call that an IPO or an initial public offering. That's the first time a public company goes to the stock market and people can buy shares in it. Now, when a company decides to IPO, there are pros and cons. The benefit, the big benefit is I'm going to raise a lot of money from many people. Obviously, as we said, anyone can buy shares in that company. And the first time a company does it, there's a lot of press around it. A great example is right now, you'll see like the media talking about, okay, OpenAI might IPO, or Anthropic, or Shein's IPO has been in the news for a long time. Same with Revolut. There's a lot of press around it, and that can be great for a company if it works in their favor. It can help them to raise more money than they would have otherwise been able to. And so that also adds this idea of prestige, which is, we'll come into this on the con side as well. There are lots of rules around being able to become a public company. This includes like the big document that you have to produce at the time of an IPO called a prospectus, which lawyers will really, really scrutinize in the equity capital markets practice. And what this does is it's telling investors all the details about the company, including the risk factors, what could go wrong, all the financial details. Sometimes that's great, like it can show a really positive picture about the company, but also be mindful that it can have downsides. A great example is WeWork, which revealed a lot of information that people were shocked by about the state of the financials, some creative accounting they were doing, the kind of personal loans the founder was taking. And so that's something to be mindful of. Another benefit is liquidity, which is I can go back to the market afterwards. So if I've already done an IPO, I'm a public company, I'm already keeping up with the requirements. If I need to raise even more money, I can issue more shares to raise money. It can also be helpful in the situation of buying companies, which is I can issue shares and that can form some of the purchase price for buying a company, as opposed to needing the cash available. You can also benefit employees in this way, which is, say you issue them shares in the company. When you go public, that's a chance for them to exit their investment, the same with the investors of a private company. But on the con side, we've already alluded to this. Like you need to meet certain requirements to even be a public company in the first place, which are quite stringent. But also there's lots of ongoing disclosures that you have to make. If there's any events that are going to be material to the market or the stock price, you have to reveal that. There is huge ongoing regulatory burdens, and that's not just listing for the first time, that's like to stay as a public listed company. And so all of that comes with cost, it comes with time. It means everyone's kind of looking at the stock price. You can become very focused on variations in that stock price. Obviously the cost of hiring lawyers and bankers, etc. And so that is why it's not necessarily like the most obvious choice these days. There's a lot of companies that are staying private for longer or just taking private equity because there are many risks and downsides that come to being a public company. And so it's not always an easy trade-off. But what we've done here is try to understand this other side, which is, okay, private companies, there are many ways to raise money. But if I'm of a certain size, do I want to make this decision to IPO and become a public company instead? So we've covered equity finance, and in a law firm, we've said that ranges across a few different practice areas, say like venture capital, private equity, or the equity capital markets practice, which is this idea of the IPO and raising money in that way. Now we move over to debt finance. And what we're trying to understand here is you've probably seen these articles in the press of, okay, like Cooper Chance is advised on this huge syndicated loan agreement, or White & Case is advised on this revolving credit facility. What do any of these terms mean? And I always used to wish that there was this like simple roadmap of what does the role of a lawyer or a law firm look like in the space of finance. And so that's what this visual shows. It's really like, where do the lawyers come in when a borrower is trying to raise money from a bank? And what do those steps look like? And we can break this down into more detail. So imagine a borrower has come to a bank to raise money, and the bank will do its initial, what we call due diligence checks. It's like early checks on the company. Imagine the lawyers come in like around that stage at the point of like just before the term sheet. And the concept of a term sheet you may have heard in mergers and acquisitions, the concept of a corporate practice, but it also applies here, which is if the bank and the borrower are going to have some kind of arrangement, but the bank lends the money, we want to have an early document to just make sure we're on the same page. But it's not legally binding at this stage. We don't want to fix anything until we've really investigated the company. We just want to make sure we understand what the price could be, what the amount, what the purpose is, what the interest might be, any important terms you want to keep in. And lawyers can be involved in this stage when the bank presents the term sheet to negotiate parts of that. The next stage is then moving over to due diligence. And again, this is very common in the space of M&A, but it also applies to finance, which is thinking about here, if I'm a bank and I'm going to lend a company money, I need to know if they can pay me back. That's like the main thing I care about. I want to lend to you because I make money on that. I make money from the interest payments and the fees, but also I don't want to be at risk of you not being able to pay the loan back. And so I need to investigate, are there any insolvency risks of the company, risks that you could go bust? Has that been filed anywhere? What is the company structure like? Is it international? What do all of those look like? I need to look if you've ever borrowed money before, and do you have any existing security, which we'll talk about later. And so this is the responsibility of lawyers there, to do kind of like a deep dive into the company to understand the risks involved. The next is the facility agreement. This is like a very long legal document setting out all the details of this transaction, so all the details of the loan that you're borrowing. And this facility agreement is really, from the bank side, it's how you can use this loan, what's the amount, what are the important provisions we're putting in to make sure we're protected, and we'll come into those later. From the side of the borrower, it's also giving clarity on how much are they borrowing, how can that money be used, what's the interest payments. And so this document is heavily negotiated at times between the lawyers, but it's really the main contract setting out all the important terms, and it's legally binding. Now note that when you sign this, this is what we call the exchange, but there's usually a next step called completion. That's where we actually think about the funds being transferred. Now, at the time of the facility agreement, just know that other documents are also being drafted. One is the legal opinion, and that's from the borrower's lawyers to give comfort to the lender that say the borrower legally exists, the security is valid, there's no clear legal breaches, things like that. There's also security documents being produced as well. We'll come onto that in the event there is security. When you're thinking about becoming a lawyer, I like to imagine that lawyers have this kind of toolkit available, which is, okay, the borrower, if I'm advising the borrower, or the lender, they have certain interests, right? And the borrower wants to make sure they can borrow the money in the first place. They also want to make sure they aren't too restricted. It's quite flexible in terms of how they can spend the money. Now, the side of the lender is, as we've said, I want to lend to you, but I want my money back, and I want protection in that case. And so what happens with the lawyers is they're putting stuff in the documents to, depending on who you're representing, to push for your party's needs. And I'll give you a few terms to just be aware of in the context of this facility agreement. Now, one is the representations, and these are statements about kind of the state of the company at the moment. For example, I promise the directors have the authority to sign the documents, or I promise there's no current litigation issues, or the accounts are up to date and accurate. So these are statements, which are called representations. The important thing is if they turn out to be untrue, we would call this a misrepresentation, and that can lead the bank to claim what we call an event of default, which is we want all our money back with interest now. So that's really important that the borrower makes statements that is true, really, and that's governed by the documents, but it's given the lender a protection mechanism as well. The next important term is what we call undertakings, and you can think of these as promises to do or not do certain things. For example, I promise to deliver you financial statements every quarter, or I promise not to change my business, or not to grant security to another lender. These are a bit different to the representations, not so much statements, they're promises to do or not do certain things. Next is the events of default. We've already touched on this, which is if I'm a bank, I want certain provisions that trigger what we call an event of default, which is, say if you file for insolvency, which is you're about to go bust, I want that to trigger a clause in the contract which says I get my money back, all of it now with interest. That's called an acceleration clause. And so we have a set of provisions that trigger events of default, which, just like thinking commercially, okay, I may not jump as a bank to ending the contract, claiming my money back, but it means you're more likely to come to the table because there's a risk of the bank being able to claim this. And so it keeps the negotiations up. It makes sure we have some kind of protection as the bank. And so this is one of the most important terms when we're thinking about the facility agreement. And then lastly is the kind of conditions precedent, also the conditions subsequent. You might have had this in the context of buying a company, which is, okay, the contract only goes through if we've got regulatory approval, for example. In the context of a finance agreement, what we're saying here is certain conditions need to be fulfilled before you can get your money. And this is importantly the role of often the trainee, which is I'm going to manage all the conditions the bank wants fulfilled. And I need to make sure I give regular updates about this. So for example, I make sure all the company's like board resolutions are given, all the security documents, all the financial statements, and there'll be a big list of these that the trainee has to manage, and then make sure the lender has seen them, approved, it's been sent off. And so that's a key part of the like project management side of a trainee. Okay, so we've gone into the weeds of this facility agreement. And the reason I think this is important is that the world of commercial law can be a bit confusing in the abstract. And it really helps to see, okay, what are the documents? What do they actually look like? What are the terms they're negotiating? And that can help you to understand the really critical role that lawyers play in different practice areas, like finance in this case. The kind of last part to understanding, at least for me, the space of loans and this like banking practice of a law firm is understanding the types of loans that company will want to use to borrow money. And so there's a few ways you can break this down. One is thinking about the number of lenders. So for example, with TCLA, if I'm going to the bank, I'm probably just going to borrow money from one bank, right? I'm not raising like crazy amounts of money. The bank will lend to me. But imagine a company that's raising huge amounts of money, millions and millions of pounds. That's a lot of risk for a bank. And so sometimes to be more secure, what they'll do is they'll lend you some money, and then some other banks will join together and also lend some money. And that takes the risk of any one bank. And what happens in practice is the lawyers, they will help to advise on the different roles that the banks have. So each of the banks takes a role. For example, one may get a fee from arranging the loan, one in relation to the security. And this way you can raise a lot of money, but it's coordinated through one bank, but it comes from the money itself comes from many banks. And that's what we call a syndicated loan. The other point, which is the whole world, it gets a bit confusing, is this idea of security. And the kind of simple thing I want you to understand is if I'm a bank lending to you, I can charge you interest, like great, but that doesn't stop me if things go wrong. And yes, the lawyers can put stuff in the contract, but that happens after something goes wrong. And then maybe I have to go to court and sue, and there's basically a complex process. Whereas security is this idea of, if I'm not sure about your ability to pay the money back, then what I want to do is make sure I have the ability to take some kind of ownership or possession or rights to an asset that you have, like a machinery or a factory. And that way, if you can't pay it back, I can ideally sell it in order to make my return instead. Now, security can be broken down into kind of two subsections. One is in relation to like physical delivery, and one is in relation to, I guess, like rights in an asset. The first example is a pledge. So imagine a company goes to borrow money. What this requires is physical delivery of an asset. Obviously, that's not super practical for commercial purposes. But say, for example, the common example is a share pledge, which is I'm going to borrow money. I'm going to pledge my ownership in, say, a different company that I have. And I'm going to give it way for the bank to have access to the shares of that company. For example, the shares are held on an account the borrower can't access without the lender's consent. So the next example is a lien, and a lien usually arises just due to the nature of something happening. A good example is, and probably the simplest, imagine like you leave your clothes at the dry cleaner, and say they iron and wash your clothes, and you don't pay for those clothes. They could, in theory, hold a lien over your clothes until you pay it back. So that's kind of the more kind of practical example of a lien. For our purposes, what we want to care about is the types of security on the right-hand side, the mortgage and the charges. And the mortgages are probably the one you're most familiar with in the context of borrowing money to buy a house. What happens here is the bank gets ownership, what we call legal title to the house, which it then transfers back to you once you've repaid your debt. Now, obviously that's not super practical for our purposes. Imagine a company, say I was borrowing money. We don't want to give ownership of TCLA to a bank for various reasons that would make it very hard to transact. And so that's where charges come in. And I remember when I first learned about this, it feels like a whole different world. Really the main thing to understand here is I don't want to transfer ownership, but I would maybe give the bank rights to, say, an interest in certain assets. And what we break that down into is what we call a fixed charge and a floating charge. A fixed charge is I'm going to give the bank the rights to a specific identifiable asset, like a piece of machinery, for example. The challenge of a fixed charge is I can't deal with that asset or sell it without the bank's consent. And so that's a bit tricky for me as a borrower. But the great thing for a bank is like they picked an asset. It also means if things go wrong, they have priority in getting their money back compared to the other type of charge called a floating charge. So that's the fixed charge. The floating charge is a bit different. It kind of, imagine it hovers over an asset. So it's great for hovering over a group of different assets. It doesn't need to be something concrete right now. The idea with that is it's great for me as the borrower. I can still deal with that asset. I could, like the amounts could change within it. But if something goes wrong, that triggers this provision in the agreement. The floating charge, what we say, crystallizes on an asset. So it holds onto an asset, becomes a fixed charge. And at that point, you can't deal with it. And so from the bank's perspective, they want as many fixed charges as possible, ideally. It gives them priority compared to anyone that lends them with a floating charge. But for a borrower, it's more practical if you get this ability to have a floating charge instead of a fixed charge. I know this is a whole complex world out there. The reason I think it's really important for you to understand this is this just comes up in the law firm process. It's like a huge part of the work of commercial lawyers in the finance practice. And so even just hearing these terms for the first time and starting to understand how they piece together will really take you a long way. So it doesn't feel that confusing when you read it. Now, the last part of these types of loans is thinking about the type of facility. On one hand, you could get an overdraft, which is very similar to the type of student overdraft you might be aware of. The idea is that's great for small amounts of money. Say if there's just a difference in which I have expenses coming out, I go to -0, so beyond the balance in my account, I need a bit of money to dip into until I go out of it. And the bank will get a fee for that. There's a cost of dipping into your overdraft, and it's good for small amounts. But a more common one when we're thinking about the context of borrowing money is corporate loans, like a term loan, which is I'm going to borrow money over a period of time and then pay it back with interest. And so that's great for a company because I can map out in my financial model, okay, when are the interest payments due? How much do I have to pay each month? But also I get the lump sum now. The downside compared to other types of facilities is I can't like redraw on that money. I get this fixed amount and then I pay it back over time. That's why we introduce what we call the revolving credit facility. The nice thing about a revolving credit facility is I'm going to borrow this amount of money and I can dip in and dip out as I need to. So say I have a simple example, 100,000 available to me. I can borrow 20,000 of that and then use it. And then maybe later on I decide to pay back 10,000 and then borrow 50,000 and then maybe pay back 40,000. And so you kind of dip in and pay back and you only pay interest based on the amount you're actually borrowing. So that's really good for like more flexible purposes of a company. So that's loans. The main thing I want you to be aware of is this is the banking practice of a law firm. And we have these interests of the borrower and the bank, and the lawyers acting for both sides have to kind of protect their clients' interests. And that's reflected in the documents that's produced. Now I'll move over to bonds, and lots of people hate bonds. I do too, completely understandable. Really, the simplest way I find to understand this is imagine a loan chopped up into many pieces. And so rather than say going to one lender or a small group of lenders, I'm going to raise a sum of money and many people or companies or investors are going to buy chunks of that in return for you getting some money, and you pay them back with interest over time. At the end, you will pay back a principal sum, what we call at the point of maturity. And so that's all a bond is. You can have government bonds, which is very common. You may have invested in that before. The idea is the government is going to raise money. It's quite a safe investment because you can generally trust the government will pay you back. And it's very problematic if there are risks of doing so. And so the government will raise money from many people who invest in it, and they'll pay back the bondholders over time. The same applies to corporate bonds, which is some companies will choose to raise a bond as opposed to getting a loan. This is great, especially if you're a well-established company. A great example is Apple. Obviously, Apple has a very good reputation in the market. And so that can make it easier to borrow money on better terms. And the other important mechanism here to keep in mind is the idea of credit ratings, which is very important in the time of the financial crash. But the idea here is if I issue a bond, a credit rating agency is going to rate that bond based on how risky they think it is. And so it's obviously your incentive to good rating, and there are a small number of credit rating agencies that do these ratings. And you can have kind of you can issue a bond and it can get a really good investment grade rating. And that's a positive sign to potential investors. Or you may have like a high yield or what we call a junk bond. These are like the riskiest bonds that investors can invest in, but you'll in return be getting a better interest as a result of that. So generally there's a correlation between if I'm investing in a really safe asset, I will get probably the lowest return, but I can trust I'll get the money back. If I'm investing in the riskiest assets like the junk bonds, I can expect a higher return as an investor because of the riskiness of I might not get my money back. And so this is what we call usually like the debt capital markets practice of a law firm. And this was a huge problem in the financial crisis where you had these mortgages which were packaged up into bonds. People could invest them and trade in them, but they were actually really risky, except they were rated higher than they actually were. So today we've covered equity and debt, and I've really tried to break down what do you need to know as a future lawyer with a potential interest in the space of finance or working in a commercial law firm. And you can see equity can be broken down into private equity, public equity, debt can be broken down into loans and bonds. If you can just keep in mind the terms I mentioned today, it is a journey to understanding the commercial world, but it will immediately make you more knowledgeable about the clients of a law firm, the work of commercial lawyers, and what's important to kind of know as you're entering the legal world. Now, when I was going through the law firm process, I just wish someone could sit me down and teach me all the things I needed to know, whether that's M&A, finance, private equity, how law firms work. That's the point of this series and over on TCLA. I break down this curriculum for understanding the financial world in an easy to understand way. And that way, there's one place for you to find all the really good information to actually understand how this works.